in today's call. And with that, I'll hand over to my colleague, Emmanuel Rocher, who will take you through the first part of the draft of the applications paper. Emmanuel, over to you.
Thank you, Jeff. I will make some general comments on the application paper, so that we can then after that move to the different sections from the paper. Just perhaps to start, a quick reminder about the application paper, the category of application paper written by IAIS members. As you may know, the aim of the application paper is not to produce new additional regulatory standards. The objective is to provide additional material to supervisors, including actual examples in case studies, in order to help the practical application of the insurance core principles developed by the IAIS on the matter for us of climate-related risks. We as supervisors and members of the IAIS are of the view that climate change is becoming a reality that insurers have to face and will have to face in close future in all dimensions of risk management. That's the reason why the paper is mainly focusing on the issues of corporate governance and risk management. The IAIS and the SIF are also very much convinced of the fact that the insurance sector has a specific role to play in the transition to low-carbon economies. Since 2015, we think that much work has been done by supervisors who try to understand, classify, and propose management solutions to these risks, mainly within the network of for greening the financial system, of which the Banque de France and RCPR are proud to be the founding member and coordinator. I think now that there's a growing recognition that climate risk and climate-related risks are a source of financial risks that have an impact both on the resilience of financial institutions, including insurers, naturally, as well as on financial stability. Climate-related risks affect the valuation of insurers' assets and liabilities and increase the cost of damages. Now that we are able to relate climate-related risks to the existing risk categories, we thought that there were no specific obstacle left for the integration of these risks within the IAIS framework that relies on the ICPs. So the application paper provides inputs on the way to integrate properly climate change matters into the decision-making process and the governance framework. So the application paper mainly focuses on the ICP that are dealing with mainly governance, the risk management, supervisory review and reporting, the ICP9, investment policy and strategies, and on disclosure. As you may see, we have mentioned all these ICPs within the scope of the paper in this slide in front of you. We have decided at this stage to left out quantitative aspects, I mean the impact of climate-related risks on the solvency position of insurers. This may be considered for future work, naturally. So at this stage, we have decided to focus mainly on the different ICPs mentioned previously, and on the principal field related to corporate governance, disclosure, risk management. The paper focuses on these key aspects for which it gives guidance on how to take into account these climate-related risks throughout the governance and risk management system. A few examples of implementation from various jurisdictions are included, from good practices to binding rules, with respect to the proportionality principle. So to conclude, I would just mention again that the paper has two different objectives. The first one is to help insurers implement new governance and risk management monitoring tools to face risk related to climate change. And the second one is helping supervisors to facilitate the practical application of supervisory material defined by the ICP's income frame by providing concrete examples. I think now that perhaps we have a couple of selected questions relating to the scope of the paper that we could tackle together, and on which you can vote through the polling function. So I will give you a bit of time to answer the following questions. I think for the first one, you can normally select different items, not just one. And I think we should obtain soon the different results coming from the polling. So we perhaps move to the Secretariat if they can just say how we do with the polling results, or should we move on?
Yes. Hello. This is Hannah from the Secretariat. We want to give a little bit more time for the participants. So about half of the participants have now finished the polling. So we'll be closing the poll in about in a couple of seconds from now.
Thank you, Hannah.
So the poll has ended now, and the results will be shown shortly. So over to you, Emmanuel.
Excuse me. Sorry, looking at the polling results. I don't know where it is exactly. So perhaps we can move to the next issue where, or perhaps Hannah, you want to perhaps comment, or Peter, on the results? I think yes, okay. From the results of the polling, we see that the risk management function is mainly chosen by participants, whereas the other issues are also gathering the same results. It's quite the same view on this. And concerning perhaps the second part of the questions, it's quite divided. Yeah, there is quite broadly the same result for all the mentioned issues related to macroprudential supervision, the valuation and capital requirements, conduct of business, and affordability of insurance. One thing I just perhaps wanted to say is about macroprudential supervision, where I think that perhaps Hannah could complete me. There are some works already undertaken on this issue in the future that could be perhaps shared a bit later. On the second topic, as I probably said, we have chosen at this stage not to tackle the issue, but I think that probably not. This will be done in the next future. So that's all I wanted to add from my side. Thank you. Perhaps yes, we can move to the second section, which is related to supervisory review, and I give the floor to Peter. Thank you.
Thanks, Emmanuel, and just a reminder that participants can also pop responses to any of these topics that you're hearing about into the chat box, and we can take that input on board or respond to questions from that format as well. So the second section of the paper here to talk about is around the role of the supervisor. And I think, as Emmanuel mentioned, there's a recognition that the financial risks from climate change can impact on insurers in a number of ways that can damage their prudential soundness and can also have an impact on financial stability. And there's increasing recognition of that throughout the regulatory community and the broader financial community. And so it follows from that looking into these risks is firmly within the mandate of insurance supervisors. And so that supervisory mandate around protection of policyholders and around financial stability are important considerations in shaping how we respond to how we form this paper. And it follows from that many of the ICPs are obviously relevant to how we think about responding to climate change financial risk, including ICP 9, importantly, on supervisory review and reporting. And so the paper is proposed to talk about some of the preconditions that are necessary for an insurance supervisor to adequately grapple with climate change risk. And they need to be taken into account in how the supervisor acts. The paper will talk about resource requirements for effective supervision of climate-related risks. And the intention is also that the paper will talk about some practical ways that supervisors can build in climate-related risks into how that they think about their general processes and procedures for supervisory review and reporting. And as with all of these sections and with application papers generally, the intention is very much that the paper is designed to provide a practical guide for insurance supervisors, and so it builds in examples and case studies and examples of practices that various supervisors are adopting to help give that perspective on how supervisors might choose to grasp this issue. So to talk a little bit more specifically about some of the key aspects, there's a section in the paper proposed to be on how a supervisor might integrate climate risks into their supervisory plans, material about how a supervisor might obtain both the qualitative and quantitative information they need to form an adequate assessment of the extent to which climate-related risks are material for the insurers that they supervise, and some methods for providing feedback and follow-up to institutions and to the insurance industry more generally around good practices in managing climate-related risks. So with that introduction, we might turn to the polling questions. We can have the next slide. So we have two questions here. The first is around whether participants on the call agree that climate risks should be incorporated into supervisory plans. And the options there, yes, for the entire insurance sector, Yes, but only for larger, more complex insurers, such as internationally active insurance groups. Yes, but only on a risk-based manner for insurers that are more likely to be exposed to material climate risk, or no. And the second question is a multiple response question around how supervisors should obtain information to form supervisory assessments. And we have options there for relying on public information, such as TCFD compliant disclosures, and we'll talk in more detail about disclosure later on in this call, by use of ad hoc qualitative information requests, by ad hoc quantitative information requests, or by building and integrating into the regular ongoing supervisory reporting from insurers to the insurance supervisor. So we have a few minutes here to collect the votes on this. Perhaps the Secretariat can let us know when we've reached most participants having been able to respond. Hopefully,
Yes,
participants.
more than half of the people have already responded, so we'll give it a little bit more, and then we will close the poll.
Thanks, Hannah. And hopefully, participants are able to type comments into the chat box. I'm just noting doesn't seem to be much coming through at the moment.
So we're at 65% now, so maybe some people need a bit more time, and then we will close the poll.
For the benefit of the participants on the call, I see we're at 303 participants in total at the moment. So an excellent turnout, and I'm sure we'll be able to gather a lot of useful information from these polling questions and from the commentary that comes through.
So Peter, there's a question coming in here. Maybe you can answer that one. So how do we emphasize the definition of climate-related risk to be developed? Is that left open to national jurisdictions, or will the paper also give some guidance around that?
So thank you for that, Hannah. The proposal is for the paper to provide some guidance on the different types of climate-related financial risks, and that guidance on definitions is quite consistent with the way those definitions were described in the earlier issues papers that the IAIS and SIF released, or also with various other organisations such as the NGFS. We're just waiting on here we go. Okay, so some interesting results coming through from the poll, and on question 1, we've really got two dominant responses that are nearly tied, a bit short of half of the respondents. The first is narrowly winning is that yes, climate risks should be incorporated into supervisory plans for the entire insurance sector. And in second place on 92, we have yes, but on a risk-based manner for insurers that are more likely to be exposed to climate risk. So I think in total, very strong support that climate risks should be incorporated and considered in supervisory plans. So that's good to see. And then we have on the second question, which as I said, was a multiple choice question, but the most popular response there by quite some margin is that supervisors should build information flow into their regular ongoing reporting obligations for insurers to form their supervisory assessments, and some strong support also for using public information such as TCFD compliant disclosures. Both the SIF and IAIS have been quite strongly supportive of the TCFD, and for those who haven't read it, I can recommend the issues paper that was released earlier this year that Jeff noted, which talks about some of the challenges and opportunities from TCFD. So I think with that, I will pass back to Emmanuel.
Okay, thank you, Peter. So yes, on corporate governance, if we can go back to the ICP, the ICP 7 sets expectations for insurers to establish and implement a corporate governance framework which provides for sound and prudent management and oversight of the insurer's business and adequately recognizes and protects the the interest of the policyholders. We probably were from the view that the evolution of climate risk governance means that the existing allocation of responsibilities to the board, the senior management, and the control functions till now may not be yet well as established as it is for traditional risks. As the understanding of climate risks continues to evolve, we thought that probably the roles and responsibilities of these key decision-making and control bodies should be clarified and more precisely defined. So the application paper looks at oversight and management responsibilities, the corporate culture, the role of the board, the duties related to risk management and internal control, as well as remuneration through climate risk lens. If I can make some specific comments and coming close to to bring you some more details on the paper, the application paper in particular encourages insurers to particularly ensure that the board and its members collectively and individually are aware naturally of climate-related risks and its consequences on the business conduct and solvency position of the undertaking. So we have some developments on the following areas. For instance, the governance framework should define through written policies the proper role and responsibilities of each member and of the board as a whole regarding climate-related risks. The governance framework should ensure by clear processes that climate-related risks are taken into account in the decision-making process through, for instance, the approval of the risk appetite framework. The governance framework should guarantee the appropriateness of skills, experiences, and knowledge of the board members on these topics. And it should ensure that the board is provided with regular, relevant, qualitative and quantitative data and a proper information given by the senior management and control functions. We have also dedicated developments on the remuneration policy. We found that a proper management of climate-related risks could, for instance, be a non-financial criterion on which a part of the variable remuneration could be based. this is the broad view I wanted to give on this section related to corporate governance. We can now switch to the questions we have selected for the polling, if you are ready to participate on this. So the first question is about the role of the board. In your organization, does the board take a leading role in driving action in response to climate risks? So 3 possibilities: yes, no, or not applicable for you at this stage. The second one is about the remuneration. Do you think there is a role for remuneration requirements to provide the right incentives for appropriate management of climate risks? With 3 possibilities also. And the last question is an open question. Would you support the idea of having a supervisory requirement to nominate a responsible officer to be accountable for climate risks? With different possibilities, yes, yes on the principle, but this should be at the level of the board. Yes, but this may be at a senior management level as appropriate. Or on the contrary, no or no opinion on at this stage. So we'll give you some time to answer the different questions. And then we will look at the result.
Perhaps, Emmanuel, while people are filling in the polls, we might deal with a couple of questions that have come through the chat box. And so there's one here that could the application paper be quite specific with case studies, especially as regards risk management? And I think the answer there is yes. That's very much the intention, to make the examples quite specific and concrete, and so that the guidance provided to supervisors is quite practical and actionable. We have a question here. Perhaps Emmanuel, as a European colleague, you might have some comments on how this paper sits in around the EU holistic legislative package on sustainable risk that's coming. So how do you think about this paper in that context?
Sorry. Yes, in the EU, yeah, it's a paper that will be integrated in the Pillar 2 requirements. I have not seen the precise results on the question, but I am looking at this. So sorry for that. I'm looking at the questions on that. There's also a question related to stress testing, I see, on which we will elaborate a little bit more on the following, the next section related to risk management. But I can tell you that yes, we consider that the development of scenario analysis and stress testing within the insurers could be part of the needed tools to increase climate risk management in the undertakings. That's for sure.
Yes, and Emmanuel, there was also a question coming in to appreciate a bit, a question on additional details around the scope of the paper and what was the exact reason behind including the topic of corporate governance. Maybe while we'll finish the poll, maybe you can elaborate a bit on that.
No, I mean, it's a general question. I mean, on the corporate governance, we think that climate risk is naturally an important issue now, and it is quite important for insurers and for supervisors to be sure that these risks are taken into account at the highest level within the insurance companies. And that's for this reason that we have chosen to develop this issue of corporate governance to be sure that climate risk issues are well taken into account and integrated in a way the risk management are functioning inside the organizations. There are also some questions around the remuneration. I saw if we could give some more details around the criteria on which we could base remuneration policy on climate risks. I mean, the paper will give some examples or case studies, as we said previously. So there is no just one solution or just one sole criteria to give to answer the question, but we will try to be as concrete as possible and give some examples on the way this could be integrated in the remuneration policy. So we have now the results from the last question we saw. On the first question on the board responsibility, there's a slight majority in favor of giving a role to the board, but at the same time we see that there are 35% of the participants who don't see any major responsibility to be given to the board. So I mean, I could say that probably yes, there's a small majority in favor, but it is certainly something that is not absolutely a clear response for everyone. On the second issue related to remuneration, yes, there's also some majority in favor of using this tool to provide the incentives in favor of the proper management of climate risk. But it's a bit divided. We have 28% of the participants who have not the same idea. On the last question for this idea to nominate a responsible officer, it's something that is widely shared by participants, but the wide majority of people think that this should be done at the senior management and not within the board members. So it's well taken into account. I think that now perhaps if everyone agrees, we could move on. We could move on and switch to the next slide around this issue of risk management and internal controls. So the ICP 8 sets out supervisory expectation on how insurers should establish effective system of risk management and internal controls. Given the potential impact of climate-related risks on the insurer solvency position, it is expected that these are considered within the existing categories of risks and lead to a review of the risk management framework in case of any material change in these risks. So the application paper looks at first integrating climate-related risks into the scope of the risk management system. The application paper also considers climate-related risks as part of the issues and tasks that should be taken and developed by control functions. So the risk management, compliance, actuarial, and internal audit functions. The issues also of fitness and propriety of control functions on climate-related issues are also taken into account. And then we have the question on integrating climate-related risks into the outsourcing decisions. So if I can try to be a bit more concrete on these different questions. We have within the application paper try to be more specific on the following questions. In particular, the insurers we think should ensure that control functions take into account on their fields climate-related risks in performing their tasks. For instance, the compliance function should make sure it takes into account the reputational and liability risks stemming from climate change. It should be ensured that the enterprise risk management framework properly identifies and assesses and monitors climate-related risks. For instance, it should be expected that the author contains an assessment on the impact of climate change on the solvency positions of the undertaking using different scenarios. It is also recommended that the insurers should develop quantitative and qualitative tools to assess and monitor their exposure to financial risks from climate change exposure, using, for instance, their own stress test scenario, their own climate-related risk assessment methodology. And lastly, we have developed a specific section on the outsourcing decisions, whereby we think that such climate-related risks should be taken into account while defining business continuity plan, or by ensuring that if the service provider is an asset manager, it takes into account the environmental, social, and governance preferences of the policyholders and beneficiaries in their investment portfolios. This is some of the examples I wanted to give to you on this issue of the risk management and internal functions. If we can have a look on the questions we have prepared for the polling. So two different questions. The first one is about the control function. Do you think that in your organizations you have sufficient expertise in climate risk till now? So yes, all the control function have sufficient climate risk expertise. Only some part of the control functions have, we think, sufficient climate risk expertise. No at this stage, but we think that there's an established plan to build this expertise within the next 12 months. So we said 12, but I think the idea is just to say that if you have a clear idea that this expertise will be built in a close future, this should be mentioned in this place. And this is not the case for us, or we think it's not applicable. Then the second question: how does your organization integrate climate risk into its risk management function? It's well integrated for some of your organization as a standalone risk category. This is the first solution, as an amplifier of other risks. Third possibility, it is integrated into the ERM as a combination of the above different risk categories, or you think it's not applicable at this stage? I don't know, Hannah, if you have some results on this? Yes. Thank you. So I think that we can say that most of you think that the control functions do not have, complete and sufficient climate risk expertise at this stage, or this is not widely shared within the control functions, but this is something that the undertakings are working on. And this is partly the case. This is the reason we have these answers on B and C, where some of you think that it is not something completely applicable at this stage. But yes, for the first possibility is really quite rare. And concerning the second aspect, most of you are of the view that climate risks are considered within the risk management function as a combination of two different aspects. First, it's a combination of a standalone risk category in itself, but they're also seen as an amplifier of other risks, and this mix of this way of considering climate risks that are taken into account within the ERM function till now. I don't know, Peter, if you wanted to say some words to complete what I said or what we have seen together on this issue of the risk management before moving perhaps to the next section.
So perhaps I might give a few comments in response to a question that we've had through the chat, which was around can we elaborate more on what we mean by climate risks for insurance? And so I can share some examples of that come from the paper. So the paper talks about underwriting risk, and which for non-life insurers, in particular, the impact on the frequency and of high impact natural catastrophes and weather-related insurance claims. So there's a risk there from climate risk. We'll talk in more detail in later in this call about investment risk, but clearly there's a risk there that the value of the investment portfolio might be impacted if investments are concentrated in sectors that are at risk from either physical damage from climate risks or from transitional related risks, where the value of the investments might change due to the transition to a low carbon economy. We have insurance risk, which goes to the risk that capital of an insurer is depleted because the assumptions used in setting pricing or reserving prove to be excessively optimistic due to the impact of climate risk. Operational risk, where climate risk, particularly physical risks, may impact the insurer's property, equipment, human resources, etc. Particularly where operations of the insurer are themselves exposed to climate-related physical risk. Reputational risk is one that comes through quite strongly, that where insurers are perceived to be either underwriting or investing in sectors that contribute to climate risk, they may come under criticism from various groups about being seen to contribute to climate risk in that way. And the final one here around strategic risk, where the insurer's achievement of its strategic goals is impeded because the impacts of climate risk, be they physical or transitional or liability risks, mean that the insurer can't achieve its strategic objectives. So a little bit more colour there for people about some of the ways that we see climate risk potentially playing out as risks for insurers.
Perhaps, Peter, one word just before going to the next section on the purpose of the application paper, and you can compliment me if you want. I think that the idea, I just wanted to mention, sorry if we haven't been sufficiently clear on that. We are not proposing to change the ICPs or to change or to create new standards on climate-related risks in particular. So the ICP are still the same. These ICP have been object to a multi-year review a couple of years before. So we will not change the ICPs now and not in the next coming years. So but we have just with this paper gone through the different existing ICPs and see how we could take this ICP into account and see how we could integrate this new dimension of the climate risk within the existing ICPs and constraints in order to help the supervisors be sure that these new dimensions in the risk management processes and decision processes within the undertakings are dealt with, so that the importance of this issue is well taken sufficiently in advance by insurers. So I would say this paper is like a guidance for insurance, for supervisors. It is not standard, it's not a rule, it's not directly naturally applicable to within the different jurisdiction. It just gives a guidance, a way, a practical set of expectations of what we think as supervisor would be adequate to find in the insurers when they face climate risks. So that this is just the thing I wanted to say. And again, we did not want at this stage within this particular application paper tackle the issue of the quantitative aspects, in particular the question of the solvency impacts on the solvency positions of the insurers, depending on which can be naturally impacted by climate risk. So this is not the objective of the paper at this stage. This does not mean that we will not do this work right now in the next coming years, but not at this stage. And we don't have any specific calendar to do this precisely in the next years. Thank you.
So we might turn then to the next section, which is about enterprise risk management for solvency purposes, and this follows on quite nicely from the discussion that Emmanuel just led on risk management more generally. So ICP 16 on ERM for solvency purposes is about how insurers coordinate risk management, strategic planning, and capital management together. And so the paper talks to some of those issues, particularly around how climate risks can be built into the underwriting policy and underwriting processes, and some examples of how supervisors can think about that. The paper talks about looking at, along the lines of the risks that I was speaking about a moment ago, how those risks can be built into the ERM framework, how you can assess the extent to which those risks exist in different portfolios of business, and some commentary around how policies and procedures for management of different types of risks might be developed. We've touched a little bit on this call already on stress testing and scenario analysis, but the paper includes some commentary on that question, and that's a question that is, it's one of the the most actively considered questions in the international regulatory space around how this stress testing and scenario analysis can be conducted, how it can contribute to both insurers and supervisors getting a better understanding of the extent of risk that exists in an insurer's underwriting portfolio or investment portfolio, and how the scenario analysis can also contribute to the insurer's ability to be able to make robust TCFD aligned disclosures. So we might turn to the next slide, and we've got some discussion questions here. We have two questions. The first around should supervisors require insurers to incorporate climate-related risks in their underwriting in the insurer's underwriting policy. So we have options here. Yes, it's a material risk, so it should be addressed. No, insurers should have flexibility to include it or not, or no opinion there. And then we have the second question here around do participants on the call support incorporating climate risk into the author, including through stress testing or scenario analysis? And we have options here that yes, and this should be part of the supervisory expectations. Yes, and our organisation already includes climate-related scenarios in the author. Yes, but a qualitative assessment is sufficient as opposed to a quantitative assessment, or no opinion. While people are responding to that, I'd be interested if people perhaps could provide some comments in the chat box around the question of the appropriate time horizon to be conducting this type of scenario testing or stress testing over. Commonly, stress testing for capital purposes in insurers might be done on a 1 to 3 year time horizon, and business planning and strategy setting might be done on a 3 to 5 year type horizon. We know that climate risks are going to play out over a much longer period, and so there's lots of debate and discussion about what is the right time frame to be setting these scenarios over. So interested in perspectives on that through the chat box as well. We'll give a few more minutes. A few more minutes rather, for people to respond to the poll. So we have a question here that I'll address while we're talking, or while we're taking those votes. There's a question here: is there any cooperation with the UN Principles for Sustainable Insurance Initiative? And the answer here is yes. The Sustainable Insurance Forum in particular, and the UN PSI initiative cooperating very closely and have been very closely engaged on climate risk from the inception of the Sustainable Insurance Forum. So we have a few comments in here about whether insurers should have to incorporate climate risks. Depends on how material it is based on the types of perils and the types of areas that the insurer is writing business in. So that's a good comment. And we have the polling results here now as well. So on the first question about should insurers be required to incorporate climate risks in the underwriting policy, the strongest polling option here is yes, that it should be, as it's a material risk. We have the second strong option here about that insurers should have flexibility on this regard. Not much support for the other options. And on the question of do participants support incorporating climate risk into the ORSA, majority here on yes, it should be incorporated, and some additional support for yes, and it's already being done in our organisation, or support for qualitative assessment. So I see some commentary also coming through on the question of timeframes. We have a comment that 5 to 10 years timeframe is appropriate. We have a comment that it should be incorporated in the 5-year strategic plan as well as the annual aspect. And then a comment here that the author should allow for scenarios with time horizons out to sort of 10 to 15 years, well beyond the typical author horizon. But these are, it needs to be clear that those type of scenarios are more uncertain, and the results need to be interpreted differently than perhaps for shorter term stress testing. There's lots of good commentary coming through there, very informative. Perhaps we should now move to the next slide and talk about investments. Thank you. So when we talk about climate-related financial risk, a material source of this can be impacts on the investment portfolio, both from the risk of physical damage to assets that an insurer may invest in, and also transitional risks where the value of an insurer's assets changes due to changes in consumer preferences or government policy or market structure as a result of a transition to a low carbon economy. So the way those risks can impact the investments can potentially be very complex and non-linear, and so working to understand those is an important aspect of risk management for an insurer. Clearly, an insurer seeks to invest in assets that will allow it to meet its obligations to policyholders, and so the extent to which the value of those investments can be damaged by climate-related financial risks will disrupt the ability of the insurer to adequately match the assets to the liabilities. So the paper covers a range of those aspects about how the supervisor can address these risks to investments and assess that at the insurers they regulate. So we have discussion around the need for adequate diversification of the investment portfolio, matching investments that are appropriate to the nature and duration of the liabilities, the need for the insurer to be able to properly assess and manage the risks associated with any investment that it makes, some discussion about how investment policy might be looked at in the context of the ARM framework. And as with the remainder of the paper, the idea is very much that the paper will provide practical guidance and practical examples for how supervisors might assess these risks. So we might turn to the polling question. I see a few comments and questions coming through the chat about what's the process looking forward for after this conference, and how can people comment. We'll cover that, the next steps, and the opportunities for further consultation at the end of the call. So if we can just hold on those ones for the moment, I'm sure they'll be covered off. So we have three polling questions here. The first is around how much impact do you expect climate risks to have over effective ALM? Significant, insignificant, insignificant only due to the short duration of the assets, not sure or not applicable. We have a question 2 around does your organisation make use of external sustainability ratings in making investment decisions? Yes, no, or not applicable. And does your investment management function work with investees to modify their business model to reduce their climate footprint? Yes, no, or not applicable. So question 3 really goes to the concept of stewardship of the assets that the investor, that the insurer rather, is investing in. We've got a few minutes to respond to those questions. There's a question in the chat box about can we define transition risk? So I've tried to make some comments around where transition risk can arise, but if you're interested in more on that, the first issues paper in particular that the SIF and IAIS published in 2018 was dealt with transition risk in the insurance context in some detail. So it's a reference there that I can recommend. Just allow a little bit more time to close. Have we nearly got a full complement, Hannah?
Yes, I can see that a couple of people are still finishing their answers, and then we will close the poll. Thank you.
Thank you. So we have a question in the meantime around, will the paper consider regulatory barriers to green assets, that is capital charges for sustainable infrastructure? And the answer on that is, as we've touched on at this stage, we're not concentrating or not scoping in the quantitative aspects around capital and valuation. So this paper won't deal with that, but it is a potential area for future work. So we have some responses here to the polling questions. So in response to the first question around how much impact do people expect climate risks to have over ALM, the largest response is a significant impact, and the next largest is not sure, which is perhaps interesting of itself. Does your organisation make use of external sustainability ratings in making investment decisions? Largest response here, not applicable. So perhaps that's, we've got a wide variety of different types of participants on the call. So perhaps many of them not directly making investment decisions might account for a large amount of not applicables there. And on the question, the third question around stewardship, we have a similarly large not applicable answer, but pretty even split between yes and no, other than the not applicables. Emmanuel, I'm not sure if you wanted to add anything or any more insights on investments before we turn to public disclosure.
I think a bit, not precisely on investments directly, but I think I saw there were a couple of questions regarding stress testing and the conditions we were considering this issue. So I just wanted to mention on this that as far as France is concerned, that it's an experience. We have at the ACPR, the French Autorité de Contrôle Prudentiel et Résolution, we are currently working precisely on our first climate risk evaluation, and we are at this stage working on the different scenarios we will base our exercise. Precisely, we're working on the different approaches and the different model we will use to better understand the different interactions between climate change and the macro financial conditions. So these different scenarios and the way we will approach the climate risk change and shocks to the economy will be published in the next coming weeks. So by mid-June or July this year, and afterwards, then we will publish the results of our evaluation during the first quarter of 2021. So I will just invite a participant to look at the next publication for the scenarios, and then wait a little bit more before we will publish the final results of this stress testing exercise we will complete during the whole year. Thank you, Peter.
Thanks, Emmanuel. And just a couple more questions here that I'll pick up. So one is, will the case studies in the paper consider other factors on insurers' investments, such as low yield environment and poor equity market performance globally? So the answer there is that's not the intention that the paper would cover that beyond the scope of this paper, which is focused specifically on climate risk. And then we've got a useful comment here about how climate risks are only one component of broader ESG risks, and there's a wide range of other factors that are relevant. So some of the causes some challenges perhaps in using external sustainability ratings in that regard. I'll throw to you, Emmanuel, to talk about public disclosure.
Okay, yes, thank you, Peter. I think we are running out of time, so I will try to accelerate a bit. On public disclosure, naturally, disclosure of all material risks, including the climate-related risks of insurers, are important aspects for policyholders and naturally for the market participants to have a full understanding of the financial conditions of an insurer. For some insurers, climate-related risks may have a significant impact on their insurance business, while for others, the risk may be more on the investment side. The ICP 20 includes standards for supervisors to require insurers to disclose their information on particularly the corporate profile, the corporate governance framework, the insurance risk exposure, the investment risk exposure, and lastly, on financial investments. The application paper intends to build upon the IAIS and SIF issues paper on the implementation of recommendations of the TCFD and provide good practices on the disclosure of climate-related risks. This includes practical examples of both the qualitative and quantitative information. As you may understand, whereas the issues paper on the TCFD focused more on how supervisors may encourage the implementation of the TCFD recommendations, which is naturally voluntary in principle, the application paper would describe good supervisory practices around the implementation of the ICP 20 in relation to climate-related risks, such as the disclosure, naturally, of climate-related risks and exposures, but also the process by which the undertakings have identified and measured these risks. We will give also some examples of binding regulation already in place, which can be a source of inspiration, but just a source and not absolutely the only one to be considered. For instance, we will speak about the so-called European Disclosure Regulation, which has just been adopted in the EU, and interestingly requires, apart from the classic disclosure of the climate-related risks, requires also the disclosure of the adverse impact of investment portfolios and investment decisions on environmental factors. So this is these two different parallel impacts that we will also explain in the paper, so that you can have different areas of implementation and examples also within the paper. Then I stop there. I think we can turn now to the questions. If yes, the Secretariat can help me. So we have three different questions related to disclosure. The first one is that we were asking or considering the question of whether a mandatory disclosure requirement based on the TCFD recommendation should be put in place. So, this yes or no possibility. The second question is about the TCFD compliance. Do you think that the most challenging aspect of TCFD compliance is about the quantitative aspect? So, yes for the first one, due to the inability to uncertainty regarding transition. Yes to the inability to combine weather models with catastrophe models. No is the third possibility, because we think we are able already to model the quantitative impacts, or not applicable, don't know. And last question, in your jurisdiction, do consistent taxonomies and scenarios exist in your view to support public disclosure? So we'll give you some time before then moving to the conclusion, or perhaps we could take also some questions coming from the chat. Perhaps, if I may tackle the question regarding the SIF policy on the question raised by one member about how to engage with the industry. I mean, it has been done in the past, so the SIF is particularly open to engage with the industry on its work. I think we are, and I could leave the question to Jeff, but we are considering this yes to increase this engagement with the industry. But this is something we are absolutely ready to do, and I think it could be a source of added value for our work naturally. So no problem for this question from my side. Then we can have a look on the results of the last poll. So do you support a mandatory disclosure requirement? I think it's a vast majority in favor of a yes response, so I won't elaborate too much on this. It's the most challenging aspect of TCFD compliance, the quantitative issue. So I would say that the possibility to say that there was no specific problem related to quantitative impact is not really chosen. So we have a great majority of people saying that the quantitative aspect naturally one of the key challenging aspects for TCFD compliance right now. And do you think that you have consistent taxonomies and scenarios in your jurisdiction to support public disclosure? Most of you think that this is not the case in a great number of jurisdictions till now. So I will stop there. I don't know, Peter, if you want to add some comments or answer different questions that have been perhaps raised through the chat while I was speaking. Sorry.
No. I think yeah, there's many useful questions in there, and they've all been noted so that we can look at them afterwards and consider them in the context of the paper. But I think we probably need to move to Connor for the closing remarks.
So I will leave the floor to Connor, and I think you have some question, Connor, also for you to conclude. Naturally, on the question of the next steps regarding our work on the application paper and what we will do with the industry and other participants. Thank you.
Oh, thank you very much, Peter and Emmanuel. Maybe just a confirmation that you can hear me okay, because I know I had some audio difficulties at the beginning.
Yeah, I can hear you, Connor.
Perfect. Well, thank you very much to Jeff, Peter, and Emmanuel for leading us through today's discussions. I'm pleased to offer some brief closing remarks on behalf of the IAIS. In 2019, we finalized our 2020 to 24 strategic plan. And in our strategic plan, we noted how over the past decade, standard-setting bodies like the IAIS had focused considerable efforts on addressing the fault lines exposed by the global financial crisis. From 2020 onward, we noted that the IAIS needed to shift our focus to the next horizon, towards those emerging and accelerating risks that have the potential to reshape the business of insurance. With the impact on both the assets and liabilities, as well as the role that insurers play in risk prevention and risk management across the lives of individuals and the broader economy, the IAIS recognized that climate-related risk would become an even stronger strategic focus in the coming years. As Jeff noted in his introduction, our partnership with the Sustainable Insurance Forum has resulted in considerable achievements. Our 2 recently published issues paper, and now this application paper looking at supervision of climate-related risks in the insurance sector. But even more significant, we have witnessed how climate risk has become a mainstream topic within the IAIS. Today's webinar, with over 300 participants, which I can note is a record for the IAIS, provides further evidence of the importance of this topic for our members and for our stakeholders. In closing, I have 3 important messages. First, the drafting group that Emmanuel and Peter are leading will continue to work on developing the paper. We aim to launch the consultation this fall. Secondly, to receive updates from the IAIS, you can visit our homepage at www.iaisweb.org and sign up for an email alert, which should then enable you to receive a notification when the application paper is sent out for consultation. Lastly, I wanted to highlight that while unfortunately we had to cancel our 2020 annual conference in Santiago de Chile, we are working on organizing a virtual event in November of this year and still keeping the original theme around sustainable insurance. With that, thank you very much to our colleagues who have dialed in today, and thank you very much to the team at the IAIS for facilitating this webinar. I turn it back over to you.
Thank you, Connor, and thank you all for participating. Again, just on behalf of the Sustainable Insurance Forum and the IAIS, we appreciate your contribution. We'll distill that input, and we look forward to engaging with you in the near future. Thank you, everybody, and goodbye.
Thank you, everybody.
Hi. So I'm back.
Hello.
Hello.
Okay, I'll hang up now, Connor. Yeah, bye-bye.
Sorry for having missed your discussion.
No worries. There was apparently also an issue if you dial in with an iPad or an iPhone, then you cannot join this private session.
You're on mute, Anna, I think.
Oh. Am I?
No, I can hear you.
Oh.
Can you hear me now?
Yes.
Ah, cool. It worked.
So, okay, and Sarah, what did you think?
Is Jeff satisfied with the exercise in particular? This is the most important question. We can't hear you, Jeff. You are muted.
Medium is really good. Like I think the combination of chat and voting is very powerful. And yeah, the trick is how do you actually activate the space so that you have an engaging call. I think it was great turnout. We got really rich data that we want. I think there could be some issues, Emmanuel, we were talking about with the not applicable data where we had quite a variety of people on the call, from firms to regulators to academics to lobby groups, etc. So we'll need to just look at some of the data and think about how we use that data. I think the medium is engaging. You look at things and you say, oh, well, next if you did it again, you do it differently, etc., etc. We started with 300. We only lost about 20 or 30 as the call went on, which I thought was quite good. The voting numbers were sort of less than that, but then a number of people weren't able to get on WebEx. They just came in via a phone line, so they wouldn't have been able to vote. I thought the questions worked well. So yes, I was happy. I mean, if we did it again, we'd do some things differently, but I thought by and large it worked well. What did you think, Connor?
Yeah, I thought it was really good, Jeff. What I found impressive was the ability to integrate the polling questions, because I think we could probably think about what types of questions might be better suited to an environment like that, and how we might be able to integrate that then within the presentations. Because I think it's a little bit hard because, of course, when you have a longer question with more responses, it takes people a little bit longer to read and digest, and then sometimes the gap, the amount of time needed can be quite long. But overall, I thought, yeah, I share your view. I think it went really well. The medium works. I had some initial problems, but otherwise, hopefully I was alone in those. Yeah, opportunity just to make some further enhancements to make it even better, because I suspect we're going to be doing it for a while.
Yeah, so I think one lesson is how to better manage the timing for in the polling. So what do we do in that time? And I thought Peter and Emmanuel, you got going on the questions, but when that started, you want to keep people engaged so they don't drift off and look at their phone or do something else. So I think dealing in the chat was good, but we could think about whether we gave people, there was a time remaining. I don't know whether the time remaining was set at the right length or too short, too long, whether that actually encourages. I don't think you can do a build on the way through, because then you bias the result by people going with the how they see others are voting. But how you animate that in between section could give some more thought to, I think. How did it feel to present, Peter and Emmanuel?
I mean, it's always a bit of a black box when you're sort of just talking out into space, but once you started to see some commentary coming through, you've got something to then sort of feed off, and that felt pretty okay once we had that going.
Perhaps, as you said, Peter, it's not always very easy, I thought, from my side, to animate the webinar, prepare what you have to say, the next coming slide, and then look at the chat and answering the question coming in. So it's not always so easy to do all these things together. So I think that was something that was not so easy for me. But and the other thing, but it's just it happens sometimes with the technology. I mean, I was just a little bit surprised not to see my video on the screen, so that I was not sure that everyone could see me and understand what I was saying. Whereas we did the test previously last week, it went well. So it was just a bit disturbing for me from the start, but afterwards everything went well. But yes, this question of the poll and the chat, those two possibilities at the same time, that is something that is not so easy to monitor. Yeah. Perhaps. I don't know.
Yeah, no, that's a good point, Emmanuel. I mean, so a refinement could be, Hannah and Connor, for other such things which do, is get somebody else to specifically curate the chat as you go, or be the commentator for the chat, so that the two presenters on the polling can concentrate, as Emmanuel says, on what you've just said, the questions, and what you're saying next. And you want to do a good job on that, so you're animated and and engaged with the screen. You've got to sort of like and maybe there's somebody who could be reading the chat, which is going the whole time, and pitch that in, during the polling time. So maybe that's a defined function on a call like this.
Yeah.
As you know, Jeff, I tried last week to do quite the same exercise with the IAIS on the broadly, not on the application paper, but on sustainability issues, and including the paper. And yes, there was Jeremy who was on stage, who was animating the debate, and he